Hello, everyone, and welcome to today's webcast titled Tax and Estate Planning 2024, The Capital Gains Dilemma, to sell or not to sell. Over the past several years, the federal government's budgets have introduced tax changes that have had an impact to high-income earners and business owners. In this year's budget, 2024, the federal government is proposing a change to the capital gains inclusion rate. And in today's discussion, we have John Nicola and Matt Baker, who will help us understand the key tax considerations and strategies you should be aware of as you monitor your own long-term plan. John Nicola is the founder, chairman, CEO, and chief investment officer of Nicola Wealth. John is a veteran of the financial services industry, and 2024 marks 50 years in the profession. He provides strategic leadership to Nicola Wealth and is passionate about exploring innovative solutions to clients' complex problems, and we will get to see some of that on display today. Matt Baker is a partner of Baker Tilly, and he specializes in both corporate and personal tax advisory, as well as estate compliance and planning. Matt is a leader in Baker Tilly's tax analysis efforts and has extensive experience providing advisory services and support to both private companies across multiple industries and public corporations. Without further ado, I'll pass it over to Matt Baker and John Nicola.
Thanks, Ethan, and again, hi, Matt. Good to see you. We not too long ago we wrote a newsletter to sell or not to sell, and where we wanted to go through, because so many clients feel that they should or feel under some pressure to sell certain assets to avoid the higher capital gains rates that are coming in corporately for any amount of capital gains, and personally for any capital gains over $250,000 a year. The purpose of the newsletter was to review when perhaps one should not do this. And a lot of people, after they had read the newsletter, wanted us to maybe dive into this in greater detail, which is what we are planning on doing today. There's an interesting quote from a gentleman called Jean-Baptiste Colbert, and he was the Minister of Finance for Louis XIV in France. And he said specifically, the art of taxation consists in so plucking the goose as to obtain the largest amount of feathers with the least possible amount of hissing. And that would appear to be the Liberal tax strategy over the last 8 to 9 years, since every year they've come up with something additional. So when we take a look at the history and development of Canada's personal income tax, which 0 to 50 in 100 years. Let's look at the particular events that have transpired. So the first century of income tax, 1917 to 2017, basically income tax was in 1917, 2.6% of the revenue. It's now 51% of the federal revenue that's coming in each year. The 2.3% of the population paid income tax in 1917, I should say, versus 75% today. It's relatively inefficient as a tax collection system when you compare it to, say, GST or corporate tax. So it's something that really doesn't help the government. It's very expensive to collect. The Income Tax Act itself was 6 pages long. It's now 1,412 pages long. And that was 6 years ago. And there was zero capital gains tax rate from 1867 to 1972, or 105 years, before any tax was applied to capital gains. So with that, let's take a look, and I'm going to pass this over to Matt to take a look at some more of the history and some more of the issues that we're focused on today related to capital gains taxes.
Yeah, excellent. Thanks very much, John. And Ethan, thank you for the kind introduction. So John and I thought, just to start off, it would be interesting to kind of help put things in perspective and look back to 1917, as John just did, when income tax was first introduced as a means of funding the war effort. And what we're looking at here is basically the federal marginal tax rates at different income brackets in 1917 versus 2017. And the 1917 figures have been adjusted for inflation. So as John just said, only 2.3% of the population actually paid income tax in 1917, and the highest federal tax bracket was 28%, and that only applied on income over $1.6 million. So in 1917, federal taxes they started at 4%, and they only applied on income over $2,000, which in today's dollars would be an exemption on roughly the first $33,000 of income for non-married individuals that have no dependents. So to put that in perspective, the basic personal exemption in 2017 was only $11,600. Now, as income tax measures have evolved, we can see it now applies to a much broader taxpayer base, and the top tax bracket is being applied at a significantly lower income threshold. So in the same vein as the last slide, I thought a quick recap of the capital gains inclusion rates would help frame our discussion today. And prior to 1972, as John mentioned, capital gains just weren't taxed in Canada. And it was Pierre Trudeau's Liberals, ironically, that proposed the capital gains tax back in the 1971 federal budget. And since then, the inclusion rate has varied between 1/2 and 3/4. So I did think it was a little bit interesting to note that the two periods of the highest inclusion rates that we've had historically here in Canada were both under a conservative government. And the first increase was actually proposed in 1987 by Michael Wilson. He was the finance minister at the time. And this came alongside a white paper that Mr. Wilson wrote outlining the objectives of a strong tax system. And among other measures he discussed, the white paper also mentions fairness in a tax system. And it does suggest that higher income individuals and corporations should carry a larger share of the tax burden. So now that we're up to speed on a little bit of tax history, I think we can take a look at some of the higher profile announcements from the 2024 federal budget that was released on April 16th of this tax year. First, we have the expansion of lifetime capital gains exemption, which is the amount that an individual can deduct on their capital gains resulting from the sale of certain qualifying shares of a Canadian business. And the exemption amount, which currently sits at just over $1 million and is indexed to inflation. The 2024 budget is proposing a one-time increase to $1.25 million, and then indexation continues on after 2026. And the budget's also announced this new measure they're calling the Canadian Entrepreneurs Incentive, and this is almost like a second capital gains exemption. They're working to effectively reduce the inclusion rate on capital gains for certain qualifying shares, the criteria for which are basically the same as the lifetime capital gains exemption. The changes to AMT, or alternative minimum tax, were actually announced with the 2023 federal budget, but there was some pretty significant pushback from the professional community and also the not-for-profit sector in regards to the impact that those changes would have, particularly in regards to the treatment of donations. So back in November of 2023, the government actually announced that they were going to go back to the drawing board and revise that legislation. And we'll talk a bit about this briefly in our next slide, so I'll save some of the details on that for now. And then lastly, but arguably the most impactful and certainly the budget measure that's been getting the most press is the capital gains inclusion rate, which will increase to 2/3 from the current 50%, and that's effective June 25th of this year. So for quite a few years, taxpayers, advisors, we've all been asking the question about whether an increase to the taxation of capital gains was coming, and we finally got our answer with Budget 2024. And this topic is where we're going to be spending, I think, most of our time today, and it kind of frames the underlying and driving the bulk of what John and I are discussing today. So as a very brief refresher, AMT is basically this parallel tax calculation that gets performed for individuals alongside their regular tax calculation. And the AMT rules make adjustments for certain types of income and tax credits, and then calculates a tax liability that's based on this adjusted taxable income amount. So if the AMT result is higher, the individual pays minimum tax. And that tax can be recovered in future years to the extent that the regular tax calculation in those years exceeds the calculated minimum tax. So the first announcement with the budget in 2024 was for charitable donations, which will now be 80% claimable for AMT purposes, whereas previously donations were only going to be allowed at 50% for that AMT calculation, that alternative tax calculation. There were a few other technical announcements, but really I think this was the most impactful on the charitable donation side. And this change will likely reduce the likelihood of AMT being applied where charitable donations are being made in a year by an individual. But again, it's going to be highly dependent on an individual's income sources and any other deductions that they're applying as well. The second item of note that came with the 2024 budget and AMT was the announcement that this legislation would be effective January 1st, 2024, even though this legislation hasn't actually been passed into law yet. And it's expected that it's going to come into law later this year, but in the meantime, the government's basically telling taxpayers to transact as if the law was already in effect. So last year, when the AMT changes were actually announced, probably the most significant impact was arguably on capital gains, because due to the inclusion rate discrepancy and the minimum tax rate, the standalone capital gains were always going to trigger an AMT liability where those gains exceeded this new exemption threshold that AMT sets. So the changes to the capital gains inclusion rate, arguably, that issue's been resolved going forward. However, because AMT is in effect now, and the new AMT rules are in effect now, and we're still operating under the current capital gains legislation, there's still a possibility where AMT could get triggered in like a transaction prior to June 25th. So in this example here, we can see the AMT liability difference on the same transaction undertaken before and after June 25th. Now, I mean, because AMT doesn't apply to corporations, there's a means of navigating around this potentially, albeit at maybe a tax cost of integration. But I think it should also be noted that any AMT we trigger before June 25th should be more easily recovered after June 25th under the new capital gains inclusion rate rules. So the key takeaway being that for anyone that has significant capital gains triggered before June 25th, AMT needs to be considered and probably factored into your planning so that it can either be mitigated or at least recovered in a future period.
So, Matt, I just wanted to ask a question related to that, because for an individual, obviously not capable of doing those calculations, presumably you're suggesting they would go to their accountant, who would then need to do these two separate calculations as if they were filing a 2024 tax return today to see what that difference would look like.
Yeah.
Is that correct?
Yeah, that's exactly right. And I think probably the biggest issue with that one, John, is that because this legislation is not yet law, I would say the majority of tax software out there hasn't been updated to reflect any of these changes, and it makes it very difficult for the advisors to make these calculations relying on either something they've built internally, or I know we have
Right.
Jay Goodis actually over at Tax Templates does a pretty good job of updating this kind of stuff, and he's got some tools for advisors to use in calculating this. But it is a bit of a sort of planning in the dark right now because we're not really sure what this is going to look like, at the end when it all settles.
All right. Thanks, Matt.
So moving on to the details of the capital gains inclusion rate changes. For budget 2024, as we have mentioned, the capital gains inclusion rate is proposed to go up from 1/2 to 2/3 for corporations and trusts, and from 1/2 to 2/3 on the portion of capital gains realized in the year that exceeds $250,000 for individuals. And again, all effective June 25th of 2024. So for an individual with capital gains in excess of $250,000, this essentially closes the gap on the eligible dividend tax rates, which in BC is 36.5% at the top marginal rate. So for corporations and trusts, there's currently no $250,000 exemption threshold, so the inclusion rate increase to 2/3 is effective from the first dollar of capital gains that are realized in corporations and trusts. And this is, again, as I just kind of mentioned, doubly unfortunate that the government has made this announcement without any draft legislation for the implementation of this inclusion rate change. So there's a number of potential issues that have been identified, and the scenarios where individuals are trying to make changes prior to the June 25th deadline, in many cases, again, planning in the dark, because we're kind of hoping that the desired outcome is achieved by making use of what we believe is available to us for our current tax planning tools. And I think it's unlikely, unfortunately, that we're going to see any legislation or comments from the government on this before the June 25th deadline, in which case it's going to be too late for taxpayers anyway. So more importantly, I think here is the foundational principle of the Canadian tax system being integration, meaning that individuals should be relatively indifferent to earning income personally or through a corporation, and that the next net tax result should be roughly the same. As we know, integration has almost never been perfect, but the change to this capital gains inclusion rate, if not enacted correctly, is going to significantly impact the concept of integration across the entire Canadian tax system. Looking at the example of a $1 million gain earned through a corporation under the current rules versus the proposed rules post June 25th, I think we can see that the most extreme example of the fully distributed tax rate at 39.4%, being a far cry from the personal tax rate that would be realized on a capital gain of $250,000 or less, assuming that individual was at the top marginal tax rate. In this case, you've got a tax discrepancy of almost 13%, which is quite significant. The delay in the implementation date to June 25th arguably provides taxpayers with a narrow window of opportunity to potentially plan ahead of these changes, but if such planning is actually warranted or necessary, which is really what, again, is going to frame our discussion in the coming slides. So I think here really a brief reality check is kind of needed on what the government has been telling taxpayers around the changes to the capital gains inclusion rate. The repeated message from the government has been that this change will only impact 0.13% of Canadians, which is roughly 38,000 individuals. The change is being marketed as a rich man's tax. This simply can't be true if we're going to actually look at the facts of the application. I think anyone earning gains through a corporation is going to be negatively impacted by this change as it currently stands. Individuals upon death are deemed to have disposed of all their assets, fair market value, and roughly 330,000 people die every year in Canada. I'd be willing to bet that a pretty significant number of those individuals have estates with unrealized gains in excess of that $250,000 exemption amount. Business owners without access to the lifetime capital gains exemption, particularly those that are selling the assets of their business, are going to be impacted. And then any individuals with a second property are more likely to be impacted as well. Both John and I went searching for some facts here just to get an idea of some numbers, and there are over 1.2 million employer businesses in Canada, and that figure does not include holding companies. That's just active employer businesses. And there's also roughly 1 million households that have a second property in Canada. So I'd be willing to bet there's again a pretty significant number of those properties that have unrealized gains in excess of that $250,000 exemption limit, particularly for those family properties that have been held longer term.
Matt, would you say that it's safe to say that between the capital gains inclusion rate change and the alternative minimum tax, that there's a meaningful number of Canadians that will get impacted by these changes?
Yeah, absolutely. I think the number is obviously certainly higher than 38,000. Again, just kind of staring at the facts here, 1.2 million companies, and again, that's not holding companies. And how many people are investing through holding companies these days or have residual proceeds from the sale of their business? It's just, I think it's a significant number and definitely in the millions.
Yeah, I would tend to agree with that. I think basically there's a lot of it's very disingenuous on the part of the government to come up with an estimate where there's no data to back up and support the estimate. Okay, so that makes it problematic. The fact is the data that we looked up, Matt and I looked up, was not that difficult to find.
No.
And therefore, it would be easy, relatively speaking, for the government to be able to come up with a very realistic a number of business owners and property owners just by themselves. We're not even taking into account the impact on other people who own not second homes, but simply own a second property that they rent out, or a third property or a fourth property. And they're all going to be under the impact of these rules. And they're certainly not in the top 0.13% of the population.
Yeah, and I don't necessarily want to know if I go too far down this rabbit hole, John, but I mean, if you even take that out further and look at, well, if the government's going to increase tax on the corporations and bigger corporations, I mean, that's ultimately those corporations that are part of people's pension funds and retirement savings. Those corporations are going to probably pay out lower dividends and ultimately have impacted market values, and that now affects everyone who's investing for retirement in just a simple pension fund. So I think again, if you look at the trickle down effects, it could be pretty significant for your average Canadian as well.
Yep, absolutely.
So I think we come full circle really after all that, and that being the question is to sell or not to sell, as John set out in the beginning here. At the most basic level, I think this can be approached with a break-even analysis, but that also means taking a step back and looking at the broader issues and asking the big questions. There's certainly going to be some short-term and more immediate concerns that will likely require the attention and planning prior to June 25th. Examples of those scenarios might be transactions that are already in progress and expected to close after June 25th. If you're selling qualifying shares of a business, we'd want to consider whether the expanded lifetime capital gains exemption rules might sufficiently shelter gains after June 25th. And for those businesses that are selling assets, we could look at artificially triggering some gains prior to June 25th, potentially to realize the lower tax rate ahead of the change. The same concept would be applied for the sale of real estate if one's expected to occur in after June 25. And then I think when we take a step back from the urgency that the government has implied by setting this June 25th date for the inclusion rate change, I really do think it's important that we remember that tax deferral is a fundamental planning strategy, and it has to be considered in each case. There's still a significant number of variables in a break-even calculation, but tax deferral is certainly a key point. And unless there was already a planned reason to trigger gains in the short term, in a lot of cases, it likely doesn't make sense to trigger gains before June 25th simply for the sake of locking in a lower tax rate at the expense of accelerating a tax payment.
If I could offer one example, Matt, for the short-term issues you've identified, there are many business owners who have a mortgage that has not yet renewed at these higher rates, and it's quite possible that their capital earmarked for dealing with that mortgage to a degree is in their corporation. And so that's an example I see often as an advisor that fits the category of the short-term cash requirement facilitated by a liquidation of assets with unrealized gains. And I thought I'd just volunteer that as what we're seeing on the front lines.
No, absolutely, Ethan. That's a great point because I know, we are obviously working with a number of clients, and of course, a lot of them have said, my mortgage is coming up for renewal in a couple of years, and I want to be ready to make a big payment, a balloon payment on this to mitigate the impact of the increase in the debt cost. So, certainly a great example. Okay. Now, before we go on to an actual example of a simple break-even analysis, this is a slide that John has used before, and I think we both felt it would be helpful to briefly review the concept of refundable tax, which can play a fairly key role in our planning. And John, please feel free to jump in at any time here, but the concept of refundable tax at the highest level is simply that it's a preemptive payment of tax by corporations on certain types of investment income so that those corporations don't enjoy a significant tax deferral over an individual earning that same income directly. And as the name suggests, the prepayment of tax gets refunded to the corporation when sufficient taxable dividends are then paid to the shareholders.
Right, and it can follow up, Matt, in your earlier comment that you had made about tax deferral being a critical part of tax and overall wealth planning, because these refundable taxes, even though they're an actual tax, are also at the same time a form of tax deferral when put together with some innovation and creativity. And we are going to show some examples of that as we go further through the presentation today, but it's important to recognize this slide to go over exactly what those refundable taxes are and how they are and how they're different from each other as well.
Yeah, and again, without going too far down this rabbit hole, which can be quite complicated, eligible dividends paid from a corporation would only result in a refund of corporate tax where there was a sufficient balance in the eligible refundable account. And this was, I should say, back in 2018, actually, the concept of refundable tax was a bit further complicated when they started segregating these refundable taxes into two notional accounts, being the eligible refundable tax, the ERTO, and the non-eligible refundable tax, the ERTO. So eligible dividends in BC have a top marginal rate of 36.5% roughly, and the blended integrated rate of just over 53.5%. So that's when the eligible dividends are actually earned through the corporation and paid out as from active income of the corporation. So integration on eligible dividends is actually near perfect. It's pretty close to near perfect as we can get. And where individuals are able to make use of lower marginal tax brackets on eligible dividends, the integrated rate on tax can be reduced, fairly significantly in some cases and produce a result, as John just mentioned, where your corporate refund is actually exceeding the personal tax paid in the same year. And then the non-eligible dividends paid from a corporation, these will always trigger a corporate refund of tax, whether there's a balance available in the eligible or the non-eligible account. This refundable tax generally makes up about 31% of, roughly 31% of the corporate tax paid on certain investment income, and non-eligible dividends have their top tax rate set at 48.9% in BC. So the blended integrated rate on non-eligible dividends is just over 59%. And like before, the integrated rate of tax can be reduced where you have an individual that can make use of their lower tax brackets. And I think that the takeaway from this slide, and John, please again add some more here if you think there's something else, but I think the big takeaway here is that timing and planning are really the key to efficiently recovering both types of the refundable corporate taxes.
Yeah, I think one of the things, Matt, that's important, and you certainly understand this, as an accountant, is that sometimes when professionals are presenting a series of outcomes to clients, they're doing so in the literal apples to apples comparison. So what they assume is you're trying to decide whether, say, an investment should be corporate or personal, for example, that in both cases, the taxes are paid immediately. And in the case of the corporate example, then immediately after the investment is sold, its proceeds are distributed to the individual, which triggers an additional level of personal tax. And the key to remember is that could be the case, but it could just as easily be the case that you've sold the investment, you've triggered this refundable tax credit, and you decide when you're going to take it out and looking for the most favorable time for that to occur. And that is a completely different result and more realistic in terms of how somebody would apply refundable taxes to their own personal situation.
Yeah, perfect. And agreed. So hopefully everyone is still with us after the brief stopover on the refundable tax. Now we're kind of getting back to that break-even example that we talked about in the second previous slide there, and we're going to start with Bob and Ellen. Bob and Ellen are 65 years old. They have a holding company that's built up a portfolio of 10 million in assets. They have an unrealized gain of 3 million on those assets, and they're planning to retire starting next year. Their corporate portfolio, again, we're assuming here, has a 7% pre-tax return each year, with 65% of that annual return being made up of deferred gains or appreciation in market value. Fully acknowledging that this is also much more John's area of expertise than mine. So the question facing Bob and Ellen, of course, simply to sell or not to sell, really, is, essentially would they be better off to trigger gains now or to continue to defer gains until after June 25th, much after June 25th, where the tax rate would be a little bit higher. So if Bob and Ellen sell now, they trigger tax in the corporation of $760,000. But they get a capital dividend account, a CDA of 1.5 million, meaning that's the amount that can be distributed to them completely tax-free. If they waited to trigger gains until after June 25th, their tax bill would be just over $1 million, and they would only get CDA of 1 million as well. So reduced CDA and a higher tax bill after June 25th. The basic break-even math on this, given the inputs we have, indicate that Bob and Ellen should be better off triggering gains now unless they plan to defer their gains beyond 2032. That break even could be extended out a little bit further if Bob and Ellen sprinkle dividends out to the corporation each year to trigger a corporate refund that would exceed the personal tax each of them would pay. And again, that break even probably goes out a little bit further if Bob and Ellen were to borrow from the bank and reinvest that capital to replace the funds that were lost due to the accelerated tax payment. And they would also be able to deduct the interest, theoretically, that they paid each year against their corporate income. Now, the reality is that no break even is that simple, and that we can't take the numbers as a standalone in analysis in making these decisions. And I think we really need to consider, Bob and Ellen's risk tolerance for leverage, any other long-term and short-term plans for their retirement that they might have, and also some other strategies which might be available to them that could mitigate the impact of capital gains changes without having to accelerate their tax bill, which I know John is going to cover in a lot more detail than I could later on here. So just before John, turn things over to John here to speak about some planning opportunities, I think it's worth just taking a quick moment to consider Canadians and our tolerance for tax increases. And I think we should consider what we have seen since 2015. And that is that there was an addition of another top tax bracket that now attracts a federal rate of 33%, which when you combine that with provincial tax is a combined top rate in BC of 53.5%. In 2015, the combined top rate in BC was only 45.8%. We have non-eligible dividends that now attract a personal tax rate of 48.89%, and that's up from 37, almost 38%. And recall that due to the under-integration, non-eligible dividends can attract an integrated combined corporate and personal rate of up to 59% even. The ability to split income for tax efficiency has been extremely limited due to the tax on split income rules that were introduced in 2018. It's the TOSI rules. We have the small business tax rate of 11% that's no longer available to corporations that are in passive income in excess of $150,000. So instead, all their active income now gets taxed at 27%. So they're denied a tax deferral of roughly $80,000 a year. We now have, of course, the capital gains inclusion rate going up 33%, an increase of 33%, up to a two-thirds inclusion rate. And this produces an increasingly under-integrated corporate tax landscape for those individuals that are earning their income through a corporation. So all that being said, I think I've set an appropriately bleak stage for John, and I think I'd like to pass things over to him at this point, maybe to give some good news on the good news portion of this webinar.
Well, thank you very much, Matt. And I feel a little embarrassed about this because it's kind of like good cop, bad cop. And what you've just had is, 20 minutes of bad cop, and here are all the issues and terrible things that are going to happen to you. And I get to swoop in like some sort of superhero and bring all of the planning opportunities and good news that can mitigate a lot of the negative aspects of what Matt was talking about. So let's start with just this quote from Jack Dempsey: "The best defense is a good offense." And so what are the things that can be done individually? So we broke it down into these categories, which are philanthropy, portfolio design, compensation, corporate structure, retirement savings, estate planning, and insurance. We're going to try to cover as many of these as we can, how best to use these to mitigate those tax increases that have just been discussed. So let's look at something relatively straightforward: compensation and corporate structure. So this is an individual who has a holding company, and we assume it owns at least 10% of the shares of another business, which is in an operating company, which we will call OpCo. The reason for the 10.1% is that if OpCo makes a profit, it can pay its share of the profits, whatever percentage Holdco owns, to it in the form of tax-free dividends. There's no income tax being withheld once the share ownership is over 10%. So it receives these tax-free dividends and invests in passive assets. The tax rate on those passive assets is 50.67% of the taxable return, not of the return. 30.67% of that is refundable. Now, OpCo, on the other hand, owns a business or a professional practice, could be an incorporated doctor, dentist, lawyer. The tax rate is 11% in BC if profits are under $500,000 and not part of a connected group. Otherwise, the business tax rate is 27% in BC. So the planning considerations are this: can we maximize expenses in Holdco where the tax savings of those expenses would be higher, 50.67% against at least no more than 27 in the case of the operating company? Can we consider salaries, directors' fees, interest expense, pension expense contributions, and charitable donations as being part of those expenses we want to see occur in Holdco? And Holdco also doesn't have to deal with alternative minimum tax. You saw the example that Matt presented, where in fact that could be a factor regardless in the changes to these capital gains tax rates. And then the other question, and this is the example we want to use, is we pay these refundable taxes. What happens if we are patient and wait until, let's say, pre or actual retirement, or use them as part of our estate planning process? So we'll take a look at both. The other thing to remember, you're looking at a very complicated page here, but I'm just going to try to simplify it by looking at a few of the numbers on it. We run what's called a tax efficiency analysis for all of our clients, and it shows basically, in this case, the returns they've made over a certain period of time and how much of those returns are taxable, because a lot of people assume they're paying 50% tax in a corporation from $1 on their returns, and they're not. They're paying 50% on their taxable income. This is a good example of that. This particular client had total returns of $589,000 in 2023, of which $285,000 was actually taxable income. So basically, less than half of the return was taxable. Tax payable would have been $141,000 roughly, or 23.9% effective tax rate for 2023. And when we look at the last 5 years, the average weighted tax rate for this individual comes in at 17.75%. So when doing planning, the first thing you have to be aware of is what exactly is your current tax position, because it's probably different than you think it is. This is another relatively busy summary, but I'll try to simplify it by just focusing on the key things to look at. So this discussion today has been about capital gains. And the question is, this is a 5-year summary for a particular client of ours from 2019 to 2023. And what it shows at the top is what return did they make in their portfolio, in this case $2.7 million roughly, and how much of that return was capital gains, $571,000. So the first thing is the capital gains are only 21% of their total return. And so we can now take a look at the impact then of the new capital gains tax on it, but it's going to be a lot less than people might have otherwise thought. So the taxable income is a percentage of the return. 33% of the return made was actually taxable, and the 67% was tax deferred or not taxable at all. That means the tax payable for this particular client, now this is over the entire 5-year period of time, is $429,000 roughly, and the effective tax rate is 16% of the return. Now let's assume we'd had the 2/3 inclusion rate from 2019 to now. In that case, the effective tax rate would have gone up, but it would have only gone up by 1.8% to 17.7%. So it would have been, nobody would have been happy with it, but they could have looked at it and said, wow, it's not really going to materially affect the after-tax building of my wealth. And here's a philanthropic strategy that some of our clients do anyway with their corporations. So they take their taxable return, $848,000 in this case, and they are allowed to donate $636,000 either to a charity, to what's called a donor advised fund, their own donor advised fund, so a bit like a mini foundation for each individual client, and or their own actual foundation. If they did that, their net taxable income would be $212,000. Their corporate tax payable, this is over 5 years, would have been $107,000. And effectively, that was a corporate tax rate of 4%. And in fact, if they use appreciated shares, the amount of actual tax could be lower than that. So it's very important to realize that good planning can really make a difference in what happens to wealth accumulation.
John, is it fair to make the comment that we should think about this as building blocks, and that you can stack these blocks on top of one another? Because you just described 2 strategies there that seem to fit quite well with one another.
No, you're right. I mean, so for example, Ethan, you could be in a situation where you've got this portfolio and you put it in, let's say, a holding company, which is we tend to favor. And while you know that if you trigger taxable gains or any taxable income, you are paying tax at 50.67%. The flip side of that is 60% of that tax is refundable. You just have to figure out the timing of when that is, and that you're allowed to deduct 75% of your taxable income if you want to be philanthropic, and a lot of our clients do. And then you can do even better than that if what you donate is publicly appreciated shares as opposed to, let's say, a term deposit. So the idea is to say, okay, let's take each of those characteristics, the building blocks as you described it, and say, when we stack them up together, what are we left with? And sometimes what you're left with is actually extraordinarily attractive. Here's an example. We're using Bob and Ellen again. They're 6 years ago, so now we're assuming they're 59. and they have a $3 million portfolio, and they own 100% of the shares of a family business worth $10 million. And they have shares in their holding company. They can sell the shares, and the shares are worth $500,000. The ACB is $250,000. Therefore, the gain is $250,000. And the taxable gain would be 125 if they do it by June 25th. The tax would be 63,000 paid roughly this time next year. They would create a capital dividend account, which is the tax-free portion of the capital gain, and that's 125,000. And that means then when they pay future dividends to themselves, since that dividend is not taxable, they will effectively save not less than 61,000 in tax. So the tax they pay, the corporate tax they pay, and the tax they'll save personally are very close to one another. So minimal net taxes are paid. Now, they could also do very well by deciding to donate their shares. They have a donor advised fund, and they're going to have the same capital gain. The taxable gain, if they donate the shares, is going to be zero. The corporate tax payable will be zero. And the corporate tax saved with the donation, since they've made a $500,000 donation to their own donor advised fund, is $253,350, which they would get from not paying tax on other taxable income in their portfolio. Their capital dividend account would be $250,000 of tax-free money they could take out of their company because there's no capital gains on the donation of these shares. The personal tax saved from this new capital dividend account is $122,000. And when I take the total taxes saved, the tax on the disposition of the shares, the tax saved on the donation, and the personal tax savings from the CDA, the total tax benefit is $436,000. That's 87% of the value of the $500,000 gift. And of course, they still have $500,000 in their donor advised fund, which they can use to support their favorite organizations. This is an incredibly tax efficient way of working with philanthropy and a much higher level of tax savings than most people would recognize.
And John, actually, I'd just like to even point out there that it's great to be doing that in the corporate environment because, again, AMT not being an issue for corporations, so you're not going to be necessarily concerned
Yes.
about triggering any of that tax by doing this corporately.
Yeah, you're right, Matt. And so it does keep it really streamlined that way. And the other thing to remember for a lot of people that are thinking about how personal versus corporate investments is where somebody has the luxury to choose between the two. You have to remember that in order to make personal investments, you have to get the money out of the corporation in the first place. And that there is a tax cost to taking money out of the corporation. So if it's already in a holding company, it doesn't have to come out. It can stay and be invested there, and I don't have to pay a personal tax trying to get it invested in my own name. So in most cases, it isn't going to be worthwhile stripping money out of a family holding company just so that you can have it invested as a personal investment. In most cases, it won't make sense. Now, let's look at Bob and Ellen 5 years later. So now they're 64, and the situation is they're transitioning the business to two of their kids. They've got $5 million in their portfolio now, and the holdco over the years has built up a non-refundable dividend tax on hand account of $1 million and an eligible dividend account tax account of $300,000. So they will retire starting next year. They've got $2 million in RSP and in individual pension plan assets. The maximum tax rate, these are the numbers that Matt went over before, are almost 49% on the NERTO and 36.4% on eligible dividends. Of course, that's in addition to the net 20% tax that was paid by the holding company. Okay, now the questions are this. Can they reduce the personal tax they would pay on the dividends to less than the maximum rate? And the short answer is yes, which we'll look at. When should they start their RIF and CPP and pension payments as a result of that? Okay, so let's just go back. Here's a retirement planning strategy. So the first thing they do is they defer RIF and CPP and pension payments to age 71 because they can. And they take dividends only as retirement income from age of 65 to 71, and they can split them equally. So that's 7 calendar years. To get back the $1.3 million of these refundable taxes they've got to take roughly $3.4 million in dividends, or $484,000 per year, which they'll split equally, $242,000 each. The personal taxes on the dividend each year will be around $64,000 because individuals pay tax not at the maximum rate, but at graduated tax rates. And it will reduce as a result of inflation slowly a bit each year after that. So the total taxes over 7 years that they'll pay are $900,000. But they're going to get back refundable taxes in the form of checks from the government for $1.3 million. So on a cash flow basis, their personal and corporate taxes over the 7 years are minus $400,000. They're getting back $400,000 more than they were paying. So you can appreciate that in this case, for them to get $900,000 of tax on $3.4 million of dividends means they're paying an average tax rate of 27%, not 48%, not 36% on the dividends they're receiving. That's the advantage of being patient and taking and recovering your RDTOH at a favorable moment. So this brings us to some of the things that we want to move into on the planning side that affect capital gains taxes, but also your estate planning. So we all remember the famous film, The Bucket List, one of my favorites. And the questions are, what's on your bucket list? Is it family legacy, recreational property? Is it travel? Is it avocations? Would you like to be a retired rock star? Or is it philanthropy? Or all of them. It could be any of them. But that's all important in terms of your planning. And the 5 biggest mistakes in estate planning, at least the ones we see, include spoiling your children and giving them too much, as you can see. But Mom, it's only $149.99 for my new mini iPad. And the legacies to the next generation can be a problem. Transition planning can be a problem, moving from one generation to another, especially as it relates to a family business. Tax planning in general, doing infrequent reviews of your will and other aspects, and no or poor will. In many cases, surprisingly, we have run into clients who have significant amount of wealth and haven't actually drafted a proper will at all or haven't changed it in 10 years. So let's come back to Bob and Ellen and look at this from an estate planning perspective. This is their net worth shown slightly different way. The business was worth, as we mentioned, $12 million. The holdco is $5 million of investment assets. They have $2 million in registered assets. They have $4 million of insurance, recreational property of $2 million, and a home worth $4 million. Now, as things stand right now, their estate, without any planning being done, is looking at probate and income tax fees and U.S. Estate tax fees of approximately $7.2 million in Canadian dollars. Now, they can immediately make that different if they use something called an alter ego trust to avoid probate fees, do an estate freeze to allow for their overall assets to not grow on a taxable basis in their own estate. Use a donor-advised fund, which we'll look at in a minute, and be more creative with how their insurance is being applied. If they do all 4 of these things, which they're totally capable of, their estate tax will drop immediately to $3.8 million, and it will shrink over time. So that's a savings of $3.4 million just by doing some effective planning. Now, the other thing that they need to know is how much money are they going to spend and where is it going to come from? So that's a very hard question to answer because it depends on the returns you make in your portfolio. We're going to assume $250,000 a year after tax. We're going to assume a 20% average tax rate. You saw what we looked at for our corporate accounts. We have a significant size. And we want to preserve capital after inflation. So we don't want to see our net worth and our investment capital shrinking over our lifetimes in this particular case. Now let's assume we can make a 2% return net of inflation, a 3% return net of inflation, 4% or 5%. What difference does that make? Well, if we only make 2%, we're going to need to start with $12.5 million to generate $250,000 a year after tax and index it over time. But we only need $9.5 million if we can make 1% more. And if we can then make another 1%, we only need $7 million. And if we can make that last 1%, we need $5.75 million. So 3% higher return generates $6.75 million less capital to actually meet our requirements. This is a really critical issue because a majority of clients, certainly the ones we meet initially, do not know what their total return is and net of fees and net of inflation on their investable capital. So if you achieve these objectives, there's obviously more capital for the rest of your bucket list. What else makes a difference? The tax rates on investment income, which of course we're talking about right now, gifts to children and grandkids, now, never, later. How big an estate do you want to leave actually? How much do you want to give away? And how much are the impact of the returns on spending? So each of these is a factor in the overall estate planning that you want to achieve. So if this couple just leaves things merrily along, like they don't do any particular planning, as we mentioned, they would have 18 million or 25 million of net worth today. 18 million of that is subject to disbursement, and 7 million is what they have to pay in taxes and probate fees. And if they don't change anything, basically, while their net worth should increase, but in this case only 5% a year, we're assuming, by the time 30 years has passed by and they may be then passing away, they'll have 75 million, which is still very attractive, but their tax bill will be $30 million by then, 4 times what it is today. Now, if we do something called an estate freeze, which we'll get into in a second as to what that is, it does help to minimize the tax payable on your assets. So what they do is they take the family holding company and they convert their share in it to preferred shares, which don't increase in value. And they keep voting control, and they own the existing value of the holding company. And then they issue, usually through a family trust, common shares which represent future growth, and the beneficiaries of that family trust can be, well, quite frankly, children, grandchildren, other family members, and extended family members as well. And it's a discretionary beneficiaries in terms of putting them in and taking them out. The beneficiaries do not have direct rights of ownership. That's in the control of the hands of in this case, the parents. So the way it would work is the current taxable assets obviously are in the parents' hands in the form of preferred shares. The future growth is going into a family trust, and that will be turned over to the next generation and or the other beneficiaries at a future point in time. The means then that the tax payable for Bob and Ellen will only be based on their current taxable assets. It won't grow as the company grows, which is what was going to happen in the other type of planning. So the taxes are deferred for the next generation. So the questions and issue are, how do you choose the beneficiaries? What about the impact of TOSI rules? Because they do impact family trusts, especially with minor beneficiaries, and you have to pick trustees, because obviously if you're not here, then who's going to be making the rules on the family trust? There is a 21-year rule that says if you don't disperse the assets in 21 years, you will trigger capital gains tax, and you want to keep that specifically in mind, because likely you will disperse the assets of the trust within 21 years. There are attribution rules in terms of whether income is attributable to anybody donating assets to the trust. And U.S. citizens and residents have a whole other set of tax issues that a cross-border specialist has to come in to look at. And finally, the ultimate disposition of the assets and control. Presumably, at some point in time, the next generation is getting the assets. When does that happen? How does that happen? And the benefits are lower and immediate and future taxes and control. Our clients can maintain control of the assets, both the ones in the trust and the ones that they are owning directly. And it may help in terms of avoiding issues and risks on wealth as it relates to matrimonial disputes. Now, this is pretty efficient, this model, and it's used by a lot of relatively well-off Canadians will use estate freezing. But they can make it even better by using what's called a wasting freeze. Once they issue these preferred shares, instead of taking income in the form of regular dividends on shares, they can simply have these shares redeemed over time. They'll be still be taxed as a regular dividend. And as a result of that, the capital that's left in their estate that's subject to capital gains tax would shrink. So reduce the estate liability by redeeming shares each year instead of taking dividends, same current tax, but less tax in the estate. So how does that look in terms of a chart? Well, the factors that we're looking at include a wasting freeze, alter ego trust, U.S. recreational ownership and how it's managed. We use insurance to redeem any preferred shares left in the estate. and we donate registered assets to philanthropy. The reason for that last one is this: they've got $2 million of registered assets. If they just donate the whatever's not spent in their RIF and their IPP to their children or their grant, doesn't really matter who receives it, will basically pay the maximum tax, or close to the maximum tax rate in BC, 53.5%, on the money that they receive, on the $2 million. And so the only beneficiary that can receive the proceeds of registered assets and not pay tax is in fact a registered charity or a foundation or a donor advised fund. So in their case, if they take the $2 million, if they were going to leave 10% of their estate to charity anyway, the 10% should start with the registered assets. In this case, they're a little under 10% of the value of the estate. Now, what impact does this have? Well, for starters, it means that the tax bill, even today, would go to $4 million, as we had noted earlier. Net estate would be $21 million, and then it would just shrink to $3 million, and then $1 million of total taxes and probate fees and other expenses, so that more than 99% of the estate would flow through to beneficiaries and philanthropy unimpeded from tax.
And John, I think it's really pertinent to really show what the actual value proposition is on something like this, because of course with the capital gains rate going up and that tax liability on death that would otherwise be higher than it is under our current rules,
Oh yeah,
this type of planning just has so much more value, even because you're not only able to limit your exposure at death, you're able to continue to defer taxes, which is obviously what the goal, but also as you're generating the dividends on that wasting freeze, you're getting the annual benefit of those reduced rates. And as you said, your effective tax rate, even paying out larger dividends over time, becomes much lower than the 36.5% or even the 48%. So it's just, even after these rule changes, this type of planning has so much more value than it even did before.
Yeah, and one of the other things connected to that, Matt, is that basically the refundable taxes we talked about them recovering the refundable taxes when they died, when they retired. But the fact is that had they not done that, and that $1.3 million in refundable taxes just kept growing, we could have used it effectively dollar for dollar to pay any capital gains tax that was left in the estate. Well, we don't have time to get into the technical details of pipeline planning now. The fact is that there is refundable taxes are either a form of retirement income, or they're a form of funding your future estate taxes, estate planning, as capital gains tax in your estate. Either way, the fact is you will recover those taxes one way or another. And so it's not a terrible thing having to pay them. Knowing that they're refundable is a critical issue. So let's look at this estate planning from a picture perspective. This is an estate freeze. We're going to freeze the shares at 14 million. Now, Holdco and Opco are worth 17 million, so why would we freeze them below that? Well, we would be able to ask for a discount for key man risk because Bob's critical to the value of the business. The liquidity, the business is not liquid in the form of assets, and there are taxes to pay. So if I was buying shares of the holding company which owns the business, I'm not willing to pay 100 cents on the dollar for that business. I'm expecting a discount for all three of these reasons. And then what I'm going to do is I'm going to redeem 400,000 shares annually. So this is the wasting freeze for 25 years. That's $10 million worth of shares. And at 90, I'm going to have 4 million shares I haven't yet redeemed. Now then, I'm not going to redeem any more shares because I maintain the shares. I've got 4 million of insurance. You can see in the pie chart. I'm going to use that money to redeem the shares with life insurance. And the taxes in the estate on the preferred shares will now be equal to zero. There won't be any taxes because I whittled it down to $4 million over my lifetime and using that as part of my retirement income. And the last $4 million is tax-free because of using the insurance to redeem the shares. I've also donated to a family, as I mentioned before, a foundation or a family donor advised fund with the registered assets. So when I take a look at it, this is how I get my net taxes on what would then be almost $100 million estate to less than $1 million. So this is where you kind of put the pieces of the puzzle together. Now, there's two last things we'd like you to look at. One of them is dealing with how you sell a business. I think for a lot of business owners, the new capital gains tax is it's brutal. because it's pretty impossible if you're selling the business to get around the impact of that tax. So let's say you've got like Bob and Ellen, you've got a business worth $12 million and you own the shares directly, let's just to keep it simple, and a buyer comes along and offers you the full 12 million. Maybe they're a strategic competitor or they're a financial investor like a private equity fund who are willing to write a check for $12 million. Now that means that basically under the new inclusion rates for capital gains, and that would obviously apply because even if you entered a transaction today, you certainly aren't going to close it by June 25th. So your tax bill is $4.3 million and you've got $7.7 million that goes to you. Now, maybe you're okay with that, but that is the kind of what we'll call the default. Now, another option you could look at, whether it's a management buyout or children, you could do either one this way, is you get the buyer, in this case the internal management team or the kids, to borrow sufficient to maximize your small business capital gains exemption. So let's say in this case, we'll call that $2 million because Bob and Ellen both own shares in the company. And the last $10 million, you do the financing for, and basically you take back preferred shares of $10 million, $12 million in total, and you charge a dividend rate on that, let's just say of 6%. Well, what's going to happen is there's no income tax on that $10 million until those shares are redeemed. So even 5 years, 10 years, you can keep them as long as you want. And at 6%, you're getting $600,000 a year in dividends. So if you're comfortable with the family business and its security and the way it's run, you may be quite happy to take back, whether it's 10 million, any amount that you decide. And if you take it back in preferred shares as opposed to a note, it's deferred. Okay. Now, there's a minimal tax on the original $2 million. You redeem the shares slowly over time if you want, okay? Or at death, you can use life insurance to redeem the shares. The company can own insurance on Bob and Ellen and redeem the shares at death. And depending on RDTOH balances and taxes in the estate, we're pretty sure that the total tax bill can be reduced to less than $1 million many years later as opposed to 4.6 million now. So we've gone through this analysis here quite quickly, but let's just say all of these solutions are bespoke. So just to summarize sort of what we've covered today, there are multiple tax strategies to use when it comes to overall planning that deal with capital gains tax and other taxes as well. You can make sure that your portfolio is built in a tax efficient way. Certain kinds of investments lend themselves to, especially to corporate portfolios. Make sure your retirement income and compensation models, both now and when you retire, are understood and you know what steps you're going to take. Estate planning is a critical aspect in terms of minimizing the impact of taxes in your estate as they move to the next generation. And there are a variety of exit strategies you can take with respect to your business besides simply looking at for a cash buyer for that business and paying a significant amount of tax. And when you take those 5 areas together, you can create an impact of the integrated planning and significantly reduce both the impact of personal income tax requirements a year-by-year basis, but especially those over the long term in terms of maximizing estate planning. So that, I think, is the end of our formal presentation. So Matt and Ethan, any other thoughts or comments that you guys have want to share with everybody?
Yeah, definitely. And John, I'd like to just say that I think it's great to really highlight the long-term and kind of proactive planning on this side of things, because the government arguably has created this urgency for people that this is happening June 25th, and everybody's got it in their minds that this is a big change, and it's been splashed all over the media. But again, for I think a significant number of people, the long-term strategy is going to be a better result, and there's not necessarily this urgent need to go and do something before June 25th, except for the scenarios that will warrant it. And it's a small percentage, I think, arguably, of taxpayers that are in that bucket that need attention before June 25th. But nice to see that the majority probably don't need to panic as much as they think they do.
Yeah, I agree, Ben. I think it's important for clients to appreciate, maybe to deal with their advisors, and it may be multiplicity of advisors. They're dealing with their accountants, they're dealing with firms like ours that can sit down with them and say, let's look at the facts objectively and see exactly what's going to transpire. And if there is a reason for a sale taking place, like I do have a friend of mine, and he's selling a business for $12 million to his kids. And in this case, the bank was willing to come along and finance 75% of it, so they thought that was great because that's a lot more cash up front. Well, the problem is that now that the deal's been struck, it was going to close in September. Well, that's not going to work because that will be pretty well all taxable at a 2/3 inclusion rate as opposed to 50%, which is what they planned 3 months ago when they did the deal. So now they're scrambling to actually make sure the deal closes before June 25th, because the difference in the tax that you're talking about, is approximately, they were looking at maybe taxes at the 50% rate, I'm going to say of around $2.25 million. That's gone up by $750,000 just by the stroke of a pen. So needless to say, they are an exception to the general rule that we've talked about here today, where they absolutely need to go out and make a change to the model that they had originally thought of. And there's other people in this category as well.
John and Matt, thank you for the presentation today. It was informative and clearly outlines the importance of integrated planning, and more so than ever, building personalized strategies using these building blocks you explained. For our viewers, we hope you enjoyed the discussion, and we look forward to connecting with you on tax planning strategy going forward. Bye for now.
Bye-bye.
Thank you.